Welcome to Trader DNA. In this video, I'll reveal the most effective candlestick patterns that can help you conquer the market across any time frame. Let's dive in and get started. One of my all-time favorite and most frequently used candlestick patterns for trading is the engulfing candle. I've featured it in many of my previous videos because it's such a powerful indicator. This pattern is incredibly useful as it often signals the exact moment a market reversal is about to occur. So what exactly is an engulfing candlestick? Well, the name pretty much gives it away. It's a candlestick that's in the opposite color of the previous candle and completely engulfs it. A bullish engulfing candle, for example, opens at or below the previous candle's close and then closes above the previous candle's open. Essentially, it's larger than the previous candle on both ends, giving it that engulfing appearance. Let me walk you through an example. In this scenario, we identify a strong support level where the price has bounced multiple times, clearly showing them that the level is respected by the market. When the price comes back down to this support, we might anticipate a bounce back up, but we don't want to act on assumptions alone. We need solid confirmation that the support will hold. That's where the bullish engulfing candle comes in. It forms exactly at the support level, completely overtaking the previous red candle. This is a highly bullish signal, giving us a strong indication that the price is likely to rise from this point. Confident in this signal, we enter the trade, and as you can see, the price moves up just as expected. It's crucial to understand that just because you spot a bullish or bearish engulfing candle, it doesn't guarantee the price will reverse in that direction every single time. Candlestick patterns are powerful tools, but they aren't foolproof. You shouldn't rely solely on candlestick patterns when making trading decisions. Instead, think of them as clues, hints that give you an idea of where the market might be headed. They're not definitive decision makers on their own. To trade effectively, you should combine candlestick patterns with other tools like support and resistance levels, technical indicators, and different trading strategies. These additional tools provide a stronger context and help confirm your predictions, making your trades more reliable. So let me emphasize this. Just because you spot a bullish engulfing candle doesn't automatically mean the price will go up. However, it can serve as a solid indication that the price is more likely to move in that direction. By using it alongside other strategies, you can improve your odds of success significantly. Let me walk you through a bearish example to help you see how this works in the opposite direction. Here we have a similar setup to the bullish case, but this time it's at a strong resistance level, a level the price has respected multiple times in the past. As the price climbs back up to this resistance, it starts to lose momentum, and that's when we spot a bearish engulfing candle. This candle completely overtakes the previous green candle, signaling a potential rejection at the resistance level. This bearish engulfing pattern is a strong indication that the price is likely to reverse and move downward, making it an excellent opportunity to go short. And what happens next? Just as expected, the price drops, validating the signal and confirming the strength of this pattern when combined with a reliable resistance level. Let's talk about the momentum candle. The momentum candle is significantly easier to identify compared to the engulfing candle, primarily due to its size. It stands out because it's typically 2 to 3 times larger than the candles that came before it. This type of candlestick is incredibly powerful because in most cases, when it appears, the price tends to continue moving in the same direction. This makes it an excellent signal for a potential entry point into a trade. The most effective way to leverage this pattern is in choppy or sideways markets where the price moves within a range of the range without a clear trend. If you notice a market moving sideways and then spot a massive momentum candle 2 to 3 times bigger than the preceding candles, you can be fairly confident that the price is likely to follow through in that direction. Why does this happen? Let me break it down for you. Picture a sideways market like this. Traders who went short are now stuck in their positions. They're hesitant to exit because the price hasn't chosen a clear direction yet. It's just moving sideways and could still break either way. These traders often mark support and resistance levels and place their stop losses just above the support area. This creates a cluster of stop losses around this zone. When a sudden price movement occurs and hits this liquidation area, all those stop losses get triggered, creating a chain reaction. This influx of buy orders from the stop losses being hit adds momentum, fueling the price to keep climbing. What's more, once the price breaks out of a choppy market like this, it often signals the start of a new trend in that direction. The same principle applies to short positions. If you spot a sideways market followed by a massive red candle 2 to 3 times larger than the ones before it, that's a strong signal to consider entering a short trade. This is because it's highly likely that the price will continue its downward movement, making it an excellent opportunity to capitalize on the trend. The next candlestick pattern we'll explore is called the tweezer. This pattern consists of a red candlestick followed by a green candlestick, both with similar wicks on the bottom. When you spot this formation, it's often a strong signal that the price is preparing to move upward. Let's break it down with an example. Here, the price approaches a key support level. First, we see a red candle with a bottom wick forming right at the support. Immediately after, a green candle appears, also with a bottom wick. This combination tells us that the price is respecting the support level and beginning to gain upward momentum. At this point, it's an excellent opportunity to buy, and as you can see, the price does exactly that. It rises. For a bearish signal, the logic is the exact opposite. You'd look for a green candlestick followed by a red candlestick, both showing wicks at the top. This pattern signals that the price is respecting a resistance level and is likely to reverse downward. In this chart, we see that exact setup and sure enough, boom, the price drops. Next, let's talk about the multiple candlestick pattern. This is easily one of my favorite patterns because it tends to be highly reliable when you see it on the charts. Plus, it's incredibly straightforward. The idea is simple. When you have 3 or more consecutive candles with wicks pointing in the same direction, you've got yourself a pattern worth noting. The more candles you see, the stronger the signal becomes. I particularly like combining this pattern with support and resistance levels for added confirmation. Take a look at this chart. What stands out to you? For starters, there's a key support level where the price has repeatedly bounced off. Now notice the multiple candles with downward wicks forming right at that support. Each of these candles shows sellers attempting to break below the support level, but buyers keep stepping in and overpowering them. This repeated rejection confirms that this is a significant support zone, and there's a high probability the price will bounce upward from here. As I mentioned earlier, the more candles you see with this pattern, the greater the likelihood the price will respect it. Now let's flip the script and consider a short example. Imagine the price has risen to a resistance level. You start to see multiple candles with wicks pointing upward, signaling that the price is struggling to break through this level. This gives us a strong indication of potential reversal. So, we enter a short trade here, expecting the price to drop, and sure enough, it does exactly that. Now, let's dive into the Dogee candle. The Dogee candle is a unique candlestick pattern characterized by a very thin body and wicks extending from both sides. It's a crucial pattern to understand because it often serves as a strong signal that the price might be gearing up for a reversal in direction. What the Dogee candle essentially represents is market indecision. It indicates that neither buyers nor sellers are firmly in control, leading to a standoff. This uncertainty often results in resistance to the current trend, and more often than not, the price reverses in the opposite direction. Let's take a closer look at an example. Here we see the price trending sharply downward. Then a green candle appears, and it just so happens to be a Dogee. This signals a shift. Sellers are losing confidence and buyers are beginning to step in. This makes it an excellent point to consider entering a trade. What I typically like to do with Dogee candles is wait for confirmation, watching for 2 or more candles of the same color following the Dogee to verify that the reversal is indeed underway. This approach helps ensure a stronger probability of success. In this example, I spot a green Dogee candle. I wait patiently and observe 2 or more green candles forming and moving upward. This confirms for me that the price is likely to continue in that direction. At this point, I confidently enter the trade, and just like that, boom, the price moves up from there. Now it's worth noting that there are several variations of the Dogee candle you might encounter. The classic Dogee, which we just discussed, is the most common. Then there's the long-legged Dogee, which is similar but features extended wicks on both sides. You also have the dragonfly Dogee, characterized by a small body and a long bottom wick, and the gravestone Dogee, which has a small body and a prominent upper wick. Although these variations may look slightly different, they all convey the same essential message, a potential reversal in price. Recognizing these subtle differences can enhance your ability to read the market and identify key opportunities. The next candlestick pattern we'll be focusing on is the hammer. The hammer is a distinctive candle characterized by a relatively small body and a long lower wick. It tells a clear story. Sellers managed to push the price significantly lower, but buyers stepped in and absorbed all that selling pressure, driving the price back up to close near its opening level. This makes the hammer an incredibly bullish signal, often indicating that the market is poised to move upward in the same direction. A closely related candlestick pattern is the shooting star. The shooting star resembles the hammer, but is essentially its inverse, featuring a long upper wick and a small body with a shorter lower wick. It is traded similarly to the hammer, but in this case it signals a potential reversal to the downside. When you spot a shooting star in the right market context, it's a strong indication that the price could begin moving in the opposite direction. Both patterns are powerful tools for identifying potential market reversals. And the final candlestick pattern we'll discuss is the Marabu. A bullish Marabu is a large green candle without any wicks, essentially just a solid green rectangle. What's fascinating about this pattern is that it serves as a strong confirmation that the price will likely continue moving in the same direction. You'll often spot this candle in the middle of a trend, signaling that the upward momentum is intact and the trend is set to continue. Let's take a closer look at an example. Here we see a price reversal with the market starting to move upward. Then a bullish Marabu candle forms. Notice how this candle has no upper or lower wicks. This tells us that the lowest price during the candle was exactly the same as its opening price, and the highest price was exactly the same as its closing price. In simpler terms, buyers were fully in control throughout this period. This makes it a highly reliable indicator that the price will keep climbing, and as we can see in the chart, it does. The bearish Marabu follows the same principle, but in the opposite direction. It's a large red candle with no wicks. In this example, we see a price reversal to the downside. A bearish Marabu forms, signaling that sellers have taken full control of the market. This pattern gives us a strong indication that the price will likely keep falling, making it an ideal point to enter a short trade. And sure enough, the price continues downward, making this a successful trade. The biggest challenge when trading with candlestick patterns is dealing with false breakouts. This happens when a pattern forms, but instead of the price following what the pattern predicts, it does the complete opposite, leaving traders frustrated and caught off guard. If you're eager to learn how to avoid falling into this trap, make sure to check out my other video where I reveal my secret strategy for spotting and avoiding false breakouts. It's a game changer that can help you trade with more confidence and accuracy. Thank you so much for watching, and as always, I'll catch you in the next video.